I promise you guys, I'm going to do an analysis on Marvell stock. The stock is down 42% year to date. If you compare it with their largest competitor, which is Broadcom, Broadcom is up 44% year to date. This is a massive divergence between the two. And I'm going to talk about Marvell today, assess the risks and the upside potential with the company. So I really hope you enjoy it as always. And as you know, now we have a lot of the custom AI chips booming. And that's why many companies like OpenAI, they're partnering with Broadcom to create their own custom AI chips. You have companies like Amazon Web Services and Microsoft partnering with Marvell and Broadcom to create their own custom AI chip, and many companies are doing that because they don't want to rely on NVIDIA with everything, and NVIDIA chips are extremely expensive, so a lot of them are doing the custom AI chips, and the hyperscalers have certain applications that don't really fit with what NVIDIA has, and they would prefer to create their own customized AI chips. And this is pretty much the new trend. I think NVIDIA was kind of the old leader, and the new leader is likely AVGO, which is Broadcom. Now, in terms of the growth, the company is growing 58% year on year, 6% quarter on quarter. It's doing extremely well. They make money in 4 different segments. The first segment is data centers. It's up 69% year on year, 3% quarter on quarter. Then they have enterprise networking, which is mainly switches and a lot of different things used in the data centers. It grew 28% year on year and 9% quarter on quarter, which is impressive. Carrier infrastructure, which is a lot of things within 5G infrastructure, it's up 71% year on year, which is impressive. Consumer, which is things related to printers and other kind of chips related to consumer products, it's up 30%. And the automotive business, they sold it for $2.5 billion, and they will reinvest the money for them in the data center business. And it also announced a pretty massive buyback program to buy back some stock. Okay. Now, the last quarter was actually very good. The company beat on earnings per share, and they met revenue expectations. But the main reason why the stock was going down is because they guided Q3 revenues to be pretty much flat sequentially. And they said overall data center revenue in Q3 is to be flat sequentially, which he attributed to nonlinear growth in the custom AI chip business. Fourth quarter growth is expected to be substantially stronger. So he said pretty much it's lumpy. Now, whenever you have a lot of lumpiness in semiconductors, this is an indication that Marvell is highly dependent on 1 or 2 customers, and they have a lot of customer concentration. And if you have a lot of customer concentration and you lose this customer, it becomes a very risky value proposition, because if they had multiple customers, they wouldn't have such lumpy growth every single quarter. And there's a lot of estimates that Amazon Web Services makes up 76% of the data center revenue. 76% is a lot. And if they do lose Amazon, it could be detrimental to the company. But I don't think they're going to lose Amazon, because just in December 2nd of 2024, they signed a 5-year contract with Amazon Web Services for them to design the AWS chips. And they keep signing contracts with AWS, with contracts with Microsoft. I believe they have something with Meta as well, if I'm not mistaken. But I don't believe they're going to depend on Broadcom for everything. And I think Marvell will likely have a place. Now, in terms of the company's profitability, it is unprofitable. So if you look at it on Yahoo Finance, you see like a negative PE ratio. It has been losing for the last 2 years in terms of GAAP earnings per share. But if you look at it on a non-GAAP earnings per share, it has actually been profitable since 2021. And this is mainly due to the massive stock-based compensation. So on a GAAP basis, the company is unprofitable, but this trend has been recently shifting. And for the last 3 quarters, the company has sequentially been profitable every single quarter on a GAAP basis, which signals a massive improvement in efficiency in operations and in the company in general, which is pretty amazing. Now, if we look at a non-GAAP forward PE ratio, the company right now is trading at 20 times earnings. 20 times earnings, if you look at this line, it has historically been a bottom for a company like Marvell. It traded as high as 57 times, as low at 10 times, now trading at 20 times. And to me, 20 times looks interesting, especially for me looking at the potential growth for the data center CapEx, and with custom chips taking market share from the traditional chips, Marvell is set to benefit a lot. And the analysts are expecting 20% earnings per share growth for the next 4 to 5 years, 20-25%. So if the company is growing 20 to 25% in earnings per share growth, and it could potentially be more than 20-25%, and you're paying 20 times earnings, you're only paying 1 time price to earnings growth, so 1 PEG ratio. And anytime you buy a company at 1 time growth or below, you're normally getting a terrific deal. And such deals, they don't come very often, as long as the 20% growth is sustainable. And based on my research and the TAM and the growth of the industry, I think 20 to 25% growth is reasonable and it's sustainable. I mean, if they get a fraction of Broadcom's business, just get little pieces, they can grow 20-25%. The industry is huge, and Marvell will always have a place. Now, for Marvell, there's a major risk with the company, which I wasn't aware of before, and I have to highlight the risk in this video. And it's mainly concentration within foreign countries. So most of their revenues doesn't actually come from the United States. Only 310 million has been coming from the United States. It has grown, but only 310 million. Now, 1.1 billion comes from other regions. I don't know which regions, but they come from other regions. And 583 million comes from China. So they have a massive exposure to China revenues, and the China revenues have been pretty much steady to declining. But 583 million, this is almost double their US business is from China. Now, if there was any kind of potential chip export bans or any kind of chip restrictions, the company could be extremely vulnerable in this case, because they have a lot of exposure to China relative to their US business compared to AMD, NVIDIA, Broadcom, and many of them. So the company has a lot of China exposure and foreign exposure, which isn't too bad, but especially the China exposure is the biggest one. And, US exposure has been growing, which is great. And China exposure has been shrinking, which is also great. And hopefully that continues on a quarterly basis, but it still doubles their US revenue. And if we have any potential restriction on chips and other things, it could be really bad for the company, and it could be extremely, extremely vulnerable to any kind of chip export restrictions. So for me, Marvell looks extremely interesting over here as a potential turnaround on bad sentiment. I kind of saw the same sentiment with AMD at $100, $90. It doesn't mean the stock can't go lower, but to me, it's starting to look very, very interesting. And this was my thesis on Marvell and my analysis, and I gave you the risk and I gave you the potential upside. So I hope you enjoyed it as always. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.